Good afternoon, everyone, and welcome to today's Netwealth webinar, this time on the very hot topic of the UK election on July the 4th. Of course, it's going to have lots of impact on financial plans and your investments potentially, and we're here today to talk about that. My name is Tom Kimchi, and I'm the Head of Advice at Netwealth, and I'm joined today by our Chief Economic Strategist, Gerard Lyons. Today, we're going to be talking a little bit about the political landscape and economic policy implications. I'm also going to be talking towards the end about some actionable recommendations, some suggestions, and things that might help you make some financial planning decisions of what we might see leading up to the election and, of course, after the election and in subsequent years. There will be a Q&A at the end, so if you have any questions as we're talking, submit them using the questions box that you should see on your screen. We'll do our best to get through as many of those as we can at the end. If you have any more personal questions or specific questions, particularly on Netwealth itself, the best thing to do probably is to email us at advice@netwealth.com. You can hopefully see the email address towards the bottom left of the screen right now. I'm going to start by passing over to Gerard Lyons, who's going to start by talking about the political landscape and some of the economic policy implications. So over to you, Jerry.
Thank you, Tom. Good afternoon to everyone. Thanks for making time available in your busy schedules. I have a slide pack that I'm going to speak through, and that will make life easier for you to understand. There are three parts to my talk. First, the current state of the economy. Second, fiscal policy. And third, other policy areas. Now, let's begin with the state of the economy. Now, obviously, we're talking about the outcome of the election. We don't know what will happen, but we are assuming that there will be a Labour victory. Of course, elections can cause shocks or surprises, and we know from 1992, no less, when John Major was re-elected, that even in the last 2 weeks of a campaign, the polls can move substantially. Notwithstanding that, we think that the debate now is about the scale of the likely Labour victory. But I'm not going to go into any more politics than that, but that's the underlying assumption here. So let's go into the state of the economy. Indeed, regardless of who wins the election, this is the economy that will be inherited. I think it's important to stress that we have a very imbalanced UK economy. One can look at this in a number of ways, in terms of place, people, or in terms of economic imbalances. In terms of place, it's London versus the rest. It's inland versus coastal. It's urban versus rural. In terms of people, there are imbalances between old and young, often linked to whether you're a homeowner or a renter, and also imbalances between skilled versus unskilled workers and their access to training and in terms of the wages people are paid. And there are economic imbalances that I will come to, particularly in terms of the current account and budget deficits. We also, therefore, against that backdrop, are a low growth, low investment, low productivity economy. So the victors at this election will inherit a difficult structural backdrop. The key turning point for Britain was 2008. The economy has not really recovered fully from the global financial crisis. Before 2008, trend growth in Britain was around 2.75%. That meant that the economy doubled in size, taking out inflation every 26 years or so. Now, trend growth might be nearer 1.25%. The economy doubles in size, therefore, every 60 years. The official forecast that assumes trend growth is around 1 2/3. But whether you argue about 1.25 or 1 2/3 is a substantial difference to pre-2008. Some people talk about Brexit. That is a political event. I'm not going to go into the details behind that. But in economic and financial terms, it's a process. It's what you do. It's not just leaving the EU, it's the policy subsequently. But it's important to stress that most of the problems that impact the UK predate 2016 or 2019, as Keir Starmer himself said last Friday when interviewed by Nick Robinson. Clearly, there are other impacts. You can't leave the European Union without there being an economic shock, as I've talked about in the past. But the problems we face are very similar to problems faced by Germany, France, and Italy, the other G7 countries in Western Europe. On the positive, though, the economy is now recovering. But economic backdrop now is very different to when Labour won under Tony Blair in 1997. Then in 1997, the world economy was growing over 4%. Now it's 3.2%. Then in 97, Blair inherited an economy that had been growing roughly about 1% per quarter in the run up to the election. Then government debt was probably around 35 to 40%. Now it's between 90 to 100%. And of course, then we had the peace dividend, or still the aftermath of that. Now we have a backdrop where defence spending is set to rise. So it's a very different economic backdrop for Labour than it was in 1997 when they last won, assuming they win this election. Let's go on to the next slide and go through some of the graphs to highlight this. This shows consumer price inflation. The good news is it's decelerating, as one can see on the right, and it's down at the target. But those two lines above it show core inflation and service sector inflation. They're currently well above the current 2% inflation target. That will likely delay the Bank of England in cutting interest rates. Indeed, just as this seminar started, the bank announced that they had voted 7-2 to keep interest rates unchanged. 2 of the 9 members of the MPC, Monetary Policy Committee, voting to cut 7 to keep rates unchanged at 5.25%. But from that graph, as service sector inflation decelerates, one would expect to see rate cuts later this year. Let's go on to the next slide. This is consumer confidence. On the left is a host of countries, and consumer confidence generally has improved. But let me highlight on the right. This is the OECD's measure of consumer confidence across major economies. On the vertical axis is the level of consumer confidence, with 100 being really seen as the sort of key barometer. So you can see countries are bunched around different levels, around 98, 99. But the important thing is the horizontal axis. To the right of 0 is an improvement in the last 3 months. To the left of 0 is a deterioration. So if you're in the bottom left-hand quadrant, you're below 100 on the vertical axis, and confidence has deteriorated in the last 3 months. What's interesting is if you look in the bottom right, both the Euro area and the UK have seen a significant improvement in confidence in the last 3 months. So the level might still be below 100, but has improved. So inflation on the previous slide is falling, consumer confidence is improving. If we go on to the next slide, another positive is this, that basically wage growth is well above the rate of inflation. Now, as in wage growth was accelerating a few months ago, this was adding to concerns at the Bank of England about core inflation. Now we're seeing inflation pressures ease, wage growth is coming off its highs. That should ease concerns about core inflation, allowing the Bank of England to ease rates. But importantly for the economy, wage growth is above inflation, which is giving the boost and will give a boost to consumer spending as we move through this year. If we move on to the next slide, I'm going to highlight, though, the structural issues facing the new government. There are 3 slides here. One is investment. This goes back to the early 70s. And the point is that this has been a problem for Britain for half a century, low investment. China would be nearer 40%, Korea and economies like that, 30%, many of the other G7 countries well above 20%. Britain is a low investment economy. Labour will focus on trying to address that. The next 2 slides highlight 2 issues. This is the current account deficit. Below 0 means that we are basically importing more than exporting, and adding our capital account, we're in a big deficit. And it means that we're reliant on overseas money to either prop up the pound, or we're reliant on money to come into the UK to sort of offset the challenges from the current account deficit. And the next slide is a key one. This is the other part of the twin deficit problem, the budget position. Government revenues versus government spending. So if we're above 0, it means the government's running a surplus. And if we're below 0, we're running a government deficit. This goes back to just before Labour winning the last election. What's remarkable in Britain is that there have been only 7 years since the 60s when we have had an annual budget surplus. Two of those were at the turn of the 1970s, after Roy Jenkins, the Labour Chancellor, had left the fiscal finances in good shape, at the height of the Lawson boom, and then very interestingly, as shown in this slide, in the period 97 to 2000, when Labour won under Blair. Then Labour inherited very tough fiscal plans. Chancellor Gordon Brown inherited the previous Chancellor Keynes Clarke's fiscal plans. Gordon Brown stuck to them. We ran a budget surplus. But it was only as we got into the budget in the year 2000 that Labour then put its foot on the fiscal accelerator, increasing government spending. And as you can see, for various reasons, not least the pandemic in recent years, we have continued to run a budget deficit. So that concludes the first part, and we move on to the next slide. But concluding the first part, we have an economy that has turned the corner, is likely to improve in the next 18 months or so, but there are underlying structural problems, not least low investment and a twin current account and budget deficit. Let's now go on to what I think will be the fiscal policy plans of a Labour government. On to the next slide, please, Tom. This is the current position. And I've put these down here so you can follow, as it's sometimes difficult when one's looking at a presentation to hear easily everything that's been said. So I'll just talk through this if I may. The current fiscal situation is poor. Debt levels are high and G is less than R. The growth rate of the economy is less than the future interest rate paid on that debt. That means that we are in a difficult fiscal situation, not far away from a debt trap. Admittedly, 6 of the G7 countries are in a similar situation. The G7, the 7 major industrialized countries. The exception is Germany. But whoever inherits the position after the election, and we're assuming it's Rachel Reeves, it's a tough backdrop. The current fiscal rules imply little headroom. And bear in mind, as I outline here, we've already seen the economic recovery factored into current fiscal plans. The independent OBR, the official forecaster, has already factored in recovery of 0.8% this year, 1.9% next year, and 2% the following year. Growth this year might be above 1% actually, or nearer 1%, so there might be some fiscal headroom later in this year, but there's not much. On top of that, the tax take is already high, and there's little fiscal room for maneuver as the fiscal plans point to spending being squeezed on non-ring-fenced areas, such as local authorities, prison service, etc. So taxes already high, squeeze already on fiscal plans, and economic recovery factored in. Rachel Reeves has said that she will have a new fiscal lock. In my view, markets will be pleased with this, initially at least. We don't know yet what it will mean, but it's likely to mean empowering the OBR. It might mean more fiscal rules. I don't think the current fiscal rules, to be frank, work, but if we see a change to them, it might well be that the government can borrow to invest, similar to a fiscal rule that Gordon Brown had for a while when he was Chancellor. And the consensus amongst economists is that spending is up, taxes will have to rise. So in that respect, Rachel Reeves will probably feel minded that technocrats will have greater say on the fiscal side. This, I would say, is possibly the current version of Labour making the Bank of England independent in 1997. Obviously, nothing will be on the scale of the impact of that. There's not going to be, it seems, any significant changes to the Bank of England's plans or to their policy framework. So the changes, if there's a surprise, might well come on this side with the new fiscal lock. If we could go on to the next slide, next 2 slides really go into detail on the fiscal backdrop. I think Labour is right to highlight the need for economic growth. Growth is the real way out. When you look at the fiscal numbers that we have in Britain, there are really 6 options available. 5 of these are under the government's remit, and the last one is partially under their remit. You can have any number of these at the same time. They can be concurrent, but the choices are this: economic growth, that's the best way out. Economic reform, not just of the private sector in terms of planning reform, but reform of the public sector as well. Gordon Brown talked about this a lot. Very easy to talk about, very hard to achieve. Austerity, that's squeezing government spending. Back in 2012, I was one of a tiny minority of economists who then argued against austerity when the economic consensus was in favour of it. Then I argued that the government would have been able to borrow at very low interest rates and lock into longer term borrowing at those rates. They could have done likewise during the pandemic. On neither occasion did they take advantage of it. After growth, reform, and austerity, these aren't in order of importance, is taxation, but the tax take is already very high. And then, of course, you can borrow, but borrowing is also already very high. The other option, which is really there to cover all the bases, is to inflate the debt array and have financial repression. I don't think that's really high up on the agenda, but one shouldn't rule it out always as an option at a future stage. But really, it comes down to economic growth and economic reform. They're the two main areas. Let's go on to the next slide. These are some of the issues that are likely to come to centre stage. Labour has already announced there will be a triple lock on income tax, national insurance, and VAT rates. They will inherit the current fiscal plans of the government. Now, within those fiscal plans, allowances are not indexed. These are income tax allowances. So the tax take will naturally rise. So many people will feel that taxes naturally are going up in coming years, particularly if wage growth brings them into a higher tax bracket. Also, the current fiscal plans already have a tough squeeze on some departmental spending, and there will be a new spending round later this year. So it's possible that the new Chancellor, Rachel Reeves, will then have to uncover new areas of revenue raising to cover any shortfall she might envisage on current spending plans and any new spending plans she may announce. Now, what are the sources of higher revenue that she could look for? Property tax, now that could include a new rating revaluation, making properties based on current price of properties rather than the present system, which is based on valuations in 1991. Capital gains tax. Tom will talk about this later. What's interesting about capital gains tax is that 1% of capital gains, 1% of those people who pay capital gains pay 45% of it. So it's a very progressive tax. Interestingly enough, 38% of people who pay capital gains on less than 50,000, and they have taxable income of less than £38,000. So it's a broad spread of people who pay it. And also fuel duty, that is an area that might come back to the fore, having been kept frozen for some time. Then there are some other areas, pension and other reliefs, and inheritance tax. There's been much talk about inheritance tax being changed at some stage, so it's a tax on the recipient, not on the giver. Also, there are some other areas, interest on bank reserves. This is a technical point, but currently because of quantitative easing, this is costing the taxpayer a lot of money. And Labour could, in theory, save around £25 billion a year if they decided not to pay commercial banks interest on their reserves at the Bank of England. Currently, Labour has indicated they will not go down this route. And then there's a future wealth tax. A wealth tax has cropped up a lot in conversations on the left. Labour's current plans do not suggest it's to the fore. But coming back to that slide I showed you about 1997 to 2000 under Blair, Blair and Brown inherited plans, they proved their credibility, and then they felt the need and the ability to do something differently as they moved into the second half of that parliamentary term. So this might be something that comes to the fore later as we move through the parliament. If we go on to the next slide, there are some other areas that you might want to sort of bear in mind. But for the markets, it's very much this, that the markets are mindful of the fact that we have seen a difficult backdrop in the last few years, and bond yields here, as shown, have already risen significantly in the UK and in other countries. There is a big difference between now and 2 years ago. When Truss did her mini budget, obviously she missed handled that. She didn't take on board market concerns. She undermined institutions. But in 2022, we also had the LDI crisis, which no one talks about now. The Bank of England was seen as being behind the curve. Inflationary pressures were rising. Now, mindful of what happened 2 years ago, Rachel Reeves is keen to keep the markets on side. That makes sense. But the backdrop is far different. Inflation is now decelerating. Interest rates look set to fall. So to conclude the second part, these are the main areas in terms of the fiscal plans for Labour. And let's move on to the next slide and the third and final part. And I take a couple of minutes here just to go through other policy areas. And if we can move on to the next slide, Tom. These are some of the issues that we can explore maybe in the Q&A, but I think you should be focused on. Institutional reform is likely. We don't know what format it will take, but institutional reform has been talked about for some time, indeed since the early 1960s. We've only had it partially, but we might see some big difference. Planning reform as well. This is something the Conservatives should have executed, but for various reasons, a group of their MPs resisted it. Institutional reform and planning reform, in my mind, are the two things that genuinely could start to drive the economic growth dial higher and make a big difference. Next is a likely future relationship. Let's close. If we go back to the previous slide, sorry, Tom. Future relationship with the EU. Labour have said they will not rejoin the single market and customs union. It clearly makes sense to have a good working relationship with the EU, but we need to see the details of that. The green agenda and net zero are clear in Labour's plans, and these will be to the fore, and they will be linked, in my mind, to a new industrial policy. Maybe it might mimic some of President Biden's IRA policy in the States. And the final thing on this page is a focus on public investment and the sovereign wealth fund. In 2008-9, I testified to the US Congress and Senate on sovereign wealth funds and state capitalism. And I wrote a note for the previous Labour government on this. And the point I raised for them was that the idea of a sovereign wealth fund then, it was the same issue as now, makes great sense. The question is how you finance it and what you spend the money on. Because most countries that have a sovereign wealth fund that works have income from a source such as a natural resource such as oil. The next slide covers some other areas, and I'll be very brief on these because you'll be able to follow these in the media. Housing, this will be center stage. There needs to be more supply. The balance here, though, will shift from owners such as landlords to renters. Workers' rights is another big area which concerns many economists. Living wage makes a lot of sense if it's voluntary. Once you make the living wage compulsory, then it starts to add to problems in terms of pressure on small firms and in terms of the pressure at the bottom of the wage pyramid. The living wage makes sense, as I say, for those firms that voluntarily embrace it. The question is how Labour will approach this. But it's very much a switch from shareholders to stakeholders. And the final thing is levelling up. Again, this has been talked about a lot in recent years. I think levelling up is best summarised by the acronym FEED. It's about finance, it's about enterprise, the private sector needs to play a part, it's empowering local authorities, which is what Labour will do, and it's diffusion. Often the spreads within regions are greater than the spreads between regions. Finally, the next few slides, just to summarize it and bring it together in terms of the markets. House price inflation is now picking up. Given that the population, according to the Office for National Statistics, is set to rise by close to 7 million by 2036, there will still be a lot of upper pressure on housing, and the key issue is whether supply will address this. The next slide highlights the Bank of England and interest rates. 5.25% now. The market assumes that rates will fall by 0.5% by year end and by another 0.25% by next May, so down to 4.5%. I think that's right. The direction of travel in the near term is for rates to fall and maybe stabilize around 4 to 4.5%. Where they go in 2 to 3 years' time is something that remains to be seen. But stabilizing probably at the end of next year around 4 to 4.5%, nearer 4.5% according to the market. And finally, the next slide is that the pound against the dollar has been relatively weak. Has to be said, many currencies have been weak against the dollar. But this is a mirroring the fact that UK assets are pretty cheap. And the possibility is that if the market takes positively, and there's often a bounce in terms of optimism when you have a new government, particularly a government with a strong mandate, then we could see the pound and UK assets benefiting. So finally, the next slide is a conclusion, 3 parts to my talk today. First and foremost, the economy is recovering, but faces structural problems. Second, Labour's fiscal plans, very much difficult backdrop. The way out of it is growth or reform, as opposed to austerity, tax, or borrow. We'll probably see a combination of some of those. And third and finally, the other areas to focus on, and in particular to highlight to you institutional reform and planning reform, as well as the possibility of a sovereign wealth fund aimed at more investment in the public infrastructure area. Thanks for your time.
Thanks very much, Jerry. That's very interesting indeed, and certainly lots to think about there. As a reminder to everybody listening in, feel free to send questions to us that we can hopefully answer at the end using the question functionality on your screen. I'm now going to move on to talking about what this means for you and some practical implications. So what does this mean for you? I think, as ever, to start with, investing remains important, regardless of exactly what happens with the economy, regardless of exactly what happens with tax rates across various products and plans you might have. Investing will be beneficial because whether inflation's 5%, 2%, it is going to erode the real value of your capital over time, as demonstrated on this chart here, which looks at cash with the effects of RPI inflation taken away from it over 25 years or so, versus investing in a balanced portfolio, which in this case is the Netwealth risk level 4 portfolio. And you can see, even though for much of this period, inflation was only around 2%, that was pretty close to the long-term average over this period, very slightly higher than 2%. And you can see, if you compare that to the return of the risk level 4 portfolio, also with inflation taken away, cash is in a much worse position. It's actually lost a lot of purchasing power, starting off with £100,000 of purchasing power and that falling to £65,000 by the end. The risk level 4 portfolio has instead increased its purchasing power, despite, as you can see on this chart, quite a negative real performance over the last few years of that period. The earlier years still more than made up for that. And the other interesting thing we often come across is clients or potential clients waiting for a market pullback before going into markets. And that might be something that's on your mind now, with markets having had a relatively strong run over the last few months. But we show here, again, 25 years or so worth of data, slightly longer. And we look at the return of risk level 4 over time. And we also, and that's the blue bar, and we also show with the grey bar at the bottom, the grey line, the drawdown periods over the same length of time. So you can see the financial crisis was a period of a relatively large drawdown. We saw coming out of the dot-com bust a relatively large drawdown. But since then, we've seen pretty strong growth over time. And there have, of course, been periods where markets have gone down. But then we've seen a new subsequent all-time high not long afterwards. So the point this chart really makes is that when you are looking for a market pullback, they're often quite difficult to time, and they don't happen as frequently or as predictably as you might think. And the overall trend here is very positive. But actually, if you cast your mind back to many of these years between, say, 2010 and 2020, say, and even past 2020, actually, at all of these points, all of these years, there were periods where people said, actually, this market run has been far too strong, and actually there's going to be a pullback soon. And of course, markets fell slightly at various points, but then, as I said, we get a new all-time high. So often the best time to get invested if you do have cash is now, with the knowledge, of course, that it's not going to be a straight line upwards, but over time you can expect a very positive return. So when investing, we think blending cash, investments and property to meet your objectives is going to be very important, and it's all about having the right blend of those different assets. So We like to break clients' overall asset base down into three pots as a way of thinking about things, and we call it our three pot theory. So pot one is your liquid, low risk pot. It's salary, it's a cash, it's an emergency fund, and it's there to meet your short-term outgoings or emergency outgoings if they come up. Jumping to pot three, this is your potentially more volatile, potentially a longer term investment, or an investment that you actually get some utility from. So it could be your residential property that you live in, it could be a second property, it could be single stocks that you hold because you have a particular interest in them or because it's a friend's company or something like that. It could be a particularly tax efficient specialist investment, but it's something that can be very volatile or can be quite hard to sell in a pinch. So it's hard to say base your retirement plans off of those assets, particularly if they're liquid. Pot two, on the other hand, is where we think most affluent people should keep most of their wealth, particularly as they're approaching retirement, say, or something where they need a relatively stable cash flow from that asset. So it should be liquid, it should be low cost, it's there for the medium to long term, and provides a diversified and stable core to your overall asset base. And how it's appropriate to look at those in the right proportions really depends on where you are in life, because I think often people, when they're younger, they have lots in cash because they might be saving for their first home, they might be building up a pension as well. They might then buy their first home and lots of their cash has gone into that property for the deposit, say. Then they might build up pot two, which is the sort of navy blue, but not quite the darkest blue on the chart here. As they approach their 60s, that retirement part, whether it's their pensions or ISAs, is building up. Of course, they can be very tax efficient vehicles to use for saving. And then as they enter their retirement, getting into their 70s, they might draw on those pot two assets, so they start to dwindle as they're enjoying their retirement and spending their hard-earned retirement funds. So these pots will naturally change over time, but what we think is really important to do is make sure that you're not holding too much cash just from inertia, really, and letting it build up. And also not putting, say, too much into property that can be quite illiquid, say, or other types of very specialist nuanced investments that might be hard to sell in a pinch and might be hard to judge accurately what the return profile is likely to be. So moving on a little bit to those pot two investments and thinking about how you invest, what sort of risk level should you consider, how adventurous should you be, how cautious should you be. We show here how your time horizon, how long the money is likely to be invested, is very, very important when making that decision. And that's certainly something we look at very carefully when advising clients formally on what level of risk they should take with their investments. So here we show three different Netwealth portfolios. Navy blue, we have risk level 2, cautious portfolio. The grey bar is risk level 4, a moderate balanced portfolio with about 50% in equities and about 50% in fixed income or bonds. And then we have the lighter blue, which is risk level 7, an equity-based adventurous portfolio. And we show for different periods of time here, 1 month all the way up to 10 years, what percentage of time, you'd have lost money in each of those periods over the last 25 years. So the first set of 3 bars looks at 1 month periods over the last 25 years, and the final section, 10 years. Of course, it actually doesn't have any bars actually showing. That shows that if you did have a 10-year period over the last 25 years, there aren't any 10-year periods where you'd have lost money, even with the more adventurous portfolio. Going back to the 1 month periods, on the other hand, even with a very cautious portfolio, risk level 2, 35% of 1 month periods would have shown a loss, which really says that if you do only have 1 month to invest, even risk level 2 is probably too risky or too adventurous for you, because albeit you are more likely to have made money than not, 35% is still a meaningful and real chance of losing money. So really, it's good to think about the time horizon. If it's just something like a retirement fund or your pension and you're a long way before being able to access it, then you can afford to take risk. You might not necessarily do so because you might be quite a cautious person, but it certainly means you can consider it. If you have, say, a 5-year time horizon, you might be sort of considering risk level 7, but as you can see there, there's still around a 10% chance of losing money. So that still might be a little bit too adventurous for you. So in general, when thinking about investing, always think about the time horizon and when you're likely to need to access the money. Moving on to some more topical points now, looking at the election, looking at what might happen in the future. I think it's worth saying in first instance, as Gerard touched on earlier, not much has been ruled out beyond changes to income tax, general VAT, and national insurance. However, there are lots of other things that haven't been ruled out, and there's been speculation that they could be changed. So I'm going to talk about some of the most relevant ones to financial planning now, and what you might want to consider in light of that, even though it is all very much uncertain. So I've listed here some things that might affect clients that we look at and speak to. So one of them is VAT on private school fees. That would mean essentially a 20% increase in the level of fees to be paid. If that does come in, and if you are planning to send your children or grandchildren or somebody else to private school, then there isn't an easy way around that as far as we know, and there might be exceptions carved out, of course. So essentially that just means budgeting more. And again, planning, looking at time horizon, looking at an appropriate level of risk. It could be that private schools in 10 years, say, so you have a higher level of risk initially, but then lower the risk as you start to pay the fees from a portfolio you've built up specifically for that purpose. The next set of items I have here relate to pensions. So we have tax-free cash, we have pension tax relief, and we have the lifetime allowance, and I'll talk about those shortly in more detail. Capital gains is something that's been talked about. Nothing's been confirmed at this stage, but that could also, of course, affect your plans if you have taxable investments. Rent caps or controls could be put in place. If you have buy-to-let property income and you're relying on that to fund your part of your retirement need or all of your retirement need, then that, of course, could affect you, and you might want to make adjustments based on that. There could be a wealth tax of some sort. Again, pure speculation at this stage what that might look like, but of course if you're a wealthy person in that case, that could affect you and your plans. And then for those that are non-doms, not domiciled in the UK, there could well be changes to that as well. And again, depending on exactly what that looks like, that could affect your plans as well. So moving on to capital gains tax specifically, currently it is low relative to income tax. That's not a controversial thing to say. You can see on the screen here that currently capital gains tax for shares or investment portfolios is 10 or 20%, depending on your tax bands. Income tax rates, though, are 20 to 45%. Also worth noting, I think that CGT rates in the UK tend to be lower than most other developed countries. So certainly an area that could be looked at, could be targeted by a future government. So I think what an illustration here shows, if you had a £500,000 portfolio now, taxable portfolio, and it's say a general account, and it's currently showing say a 30% gain because you've held it for a number of years. If you were to sell the portfolio now as a higher rate taxpayer, relative to selling it in the future, if capital gains tax as a higher rate taxpayer increased to 40%, you would actually save £23,000 in tax having sold the assets sooner and reinvested them, say. So again, it's speculation. You might not necessarily want to make a change purely based on that. It might not change, but that just gives you an idea of the likely impact of that. It would essentially mean investing in a general investment account as opposed to an ISA, as opposed to a pension, is less tax efficient. But I think worth noting overall that even if capital gains tax rates were to change, it's still likely to be beneficial to save in an invested portfolio via a general investment account as opposed to not saving. Interest on cash accounts, of course, is still liable to tax at income tax rates, so there's still likely to be an advantage. It just might not be quite as beneficial as it once was. But again, certainly worth bearing in mind. And if you've got a retirement plan in place, factoring in what this change might mean for how much income you can draw. Moving on to pensions, I think immediate changes appear quite unlikely. They haven't been listed in Labour's manifesto. And actually, if looking at the lifetime allowance specifically, this is the cap on the total level of pension savings you can have before being liable to another tax charge on top of income tax when you take money out of a pension. It has been ruled out for the time being, so things will stay as they are, but of course it could be looked at again in the future. If it was to be reinstated, it may well be that you could apply for protection, as has been the case over periods over the last 15 years or so. Not guaranteed, but that's what happened previously, even under a Labour government. Another thing you could consider, if it looks like a lifetime allowance is coming back in, is crystallising your pension ahead of that. That might give you protection depending on wording of the future legislation. Tax relief on pension contributions is another thing that could be looked at. Currently, additional rate taxpayers can receive 45% effective tax relief, which is pretty attractive, of course. That could change so that instead of getting 45%, everybody gets, say, 20%, or maybe everybody gets 30%. So a basic rate taxpayer gets an additional boost, but higher rate taxpayers get less of a boost compared to now. If this does come into place, of course, it would have been worthwhile for those that pay higher rates of tax, making a larger contribution now when high relief available is still there. So worth considering if that's an option available to you. And then the final thing I have here is tax-free cash. So currently you can take 25% of your pension tax-free, capped at £268,275. That could change in the future. Again, it's quite speculative to suggest so, but it's something that clients are often worried about. And of course, if you are worried about that, one way to protect yourself is to take that now. There are important downsides to consider here, though, such as bringing assets outside of the pension into your taxable for inheritance tax purposes estate. So if you don't have a plan for this money and it just sits in your estate and then you pass away, you might pay 40% inheritance tax that would have otherwise been avoided, or your beneficiaries would. So unfortunately, lots of speculation at this stage as plans haven't been announced, but I think these are some of the most important things to think about when looking at your plan. I wanted to touch on now how Netwealth help clients actually form their financial plans and the benefits of some of the advice we offer on these sorts of topics as they come up and as we get more detail. So as you can see here, there are lots of different areas we tend to cover with our financial advice. Not all of this applies to everyone, but we look at asset allocation and choices of risk, often with clients suggesting the right level of risk for their different objectives and goals. We often look at pension consolidation and should clients move their pensions together into one for a ease of administration and to benefit from a better service with all of those assets. We analyse income and look at income shortfalls and surpluses and what should be done with that. We can do cash flow modelling, retirement planning work. We can advise on the appropriate drawdown strategy, which of course we've talked about a lot already, pension planning more generally, and then of course estate planning and investing for children. So how much does that service cost and how much does the Netwealth service more generally cost? You can see on the screen here at the top, first of all, the fee for ongoing investment and financial planning advice, which you can see falls from 1.4% down to 0.95%, depending on how much is invested. If you don't feel the need for financial planning, those fees will drop by 0.35%. So it would be an all-in cost of from 1% down to 0.6%, depending on how much is invested. And then we do also offer one-off pieces of advice charged at £200 per hour, where we provide a fixed fee quote to you in advance and then begin the work. So that's it for the main presentation. I will now move on to some questions that have come in from the viewers. If you bear with me a second, I'll switch to my screen. So we have quite a few questions here. So let me just take a look at some of these. Here's a good one for you, Jerry, I think. Why does the Bank of England continue to stick to a 2% inflation limit? Inflation is unlikely to stick at 2%. What do you think is a likely rate of inflation over the short or medium term?
Okay, well, the Bank of England's target is given to them by Parliament. It's a 2% inflation target, and subject to that, support the government's economic policy. Inflation, the Bank of England expects to go up to 2.5% by the end of the year and then back down towards the target in coming years. We've read the inflation picture really well at Netwealth in recent years. And one of the points I stressed before was that the global backdrop, which has been so vital, has changed. Of the four global factors that kept inflation low, two of the four have changed. The two that haven't are financialization and technology, which includes AI. But the two that have changed is fragmentation has replaced globalization. So firms aren't just moving production everywhere for low costs. And in turn, as a result of that, wage shares have started to rise in Western economies, including the UK. In a nutshell, that means that inflation might settle nearer 3% than 2%. And what it means is that the Bank of England will have to work harder to keep inflation down. That means that while interest rates will fall from their current levels, they might well stabilize or settle at a higher rate than was the case before the pandemic.
Great, thank you very much, Jerry. And then we've got another one here on markets more generally. Are we able to say anything about the potential impact on markets of Trump winning the US presidential elections? I know there were some interesting impacts last time leading up to the election and then afterwards. So you able to talk about
Yeah,
that?
well, often it's the case that the markets discount things before the election date. But in the case of the US, unlike here in the UK, it looks like it's going to be very difficult to call the election before. One of the big things in the States is that fiscal policy is very relaxed. unlike the case here in Britain or on the continent. But the big difference might well be that whereas President Biden has an industrial policy focused very much on climate change, Trump would change the orientation of fiscal policy more towards tax cuts. So you would see maybe a significant shift, unfortunately, away from the climate agenda, more to the tax cuts to help business. The latter makes sense in its own right, but it's the overall mix that will be the controversial aspect. But the markets are taking the view, regardless of what you think of him as a person, the markets are taking the view that if President Trump were to be re-elected, he's likely to be better prepared than was the case the last time around. So, but I think it's better to come back to that later in the year. For now, the markets will be very much focused on both the UK election and the French election, where the French election is probably more unpredictable and is causing the stir in the bond markets. Here in the UK, the markets seem to be more settled about the outcome of the UK election.
Great, thank you very much. I've got a question here that I'll answer. It's somebody who has maximised their ISA allowances and pension allowances. They also have some buy-to-let properties, and they're wondering if they should be selling them. It's always a tricky one, that particular question, because on one hand, many people in the UK have had a great experience owning property. Values have increased, rents have been strong, and there's been lots of demand from renters, so it's probably shown you a pretty good return. On the other hand, tax treatment is much less beneficial now than it once was, and there are questions about how much UK property can continue to outperform. And then, of course, we have potential changes to the legislation around that. I think the point we tend to make most often to clients on this is often you have a lot more exposure to quite an esoteric investment with a large property portfolio than you do by having a diversified portfolio like you might have with those pot two investments I talked about. So one of our portfolios, for example, will give you exposure to hundreds of different companies, hundreds of different bonds, globally diversified, lots of different sectors. With UK buy-to-let properties, you're just exposed to the UK residential market. So it's tricky for us to say to you, yes, you should definitely sell. It could be that actually the market continues to do very well, and maybe Labour don't introduce punitive measures against property landlords. But I think it's just worth taking into account how exposed you are there to one specific sector. I've had a couple of questions as well, Jerry, on wealth taxes, and they've asked what that might look like, which I think is quite speculative. I think one thing I would say is that we already have things that are somewhat similar in some ways. So something like stamp duty could be looked at as a type of wealth tax in a way because it's a tax on a large property transaction. It's been increased recently. We have things like the lifetime allowance that affect your your pension wealth, although that has been abolished. But Jerry, would you like to sort of add what a wealth tax more generally might look like, how it looked in France or something like that, for example?
Yeah, well, the real challenge is this. The Treasury in the UK has always been more of the favour that you need to tax things where there is a identifiable income, because so you know that people have the income and therefore can pay the tax. When you start to go to wealth tax, the argument against it has always been that you might have people who are asset rich but income poor, and they might find it difficult to pay the tax and therefore might be forced to sell whatever asset it is. But Labour's now of the view that income is taxed too much, wealth needs to be taxed more, and it all really comes down to property. But you're right, as you've said it, Tom. Britain actually taxes property more than any other country in the OECD, but we tax it in a very inefficient way on stamp duty, which hits turnover. So perhaps you could see not just the desire to tax property more, but maybe a shift in how property is taxed. And that might be a case of capital gains. Labour last week ruled out, or one of the Labour shadow cabinet ministers ruled out a capital gains tax on property. A capital gains tax on property would be economically damaging. White van man, as it's known, he, she, or they are known, is heavily linked to doing up properties. A whole host of small firms are linked to helping sort of home improvements. So a large part of the economy does rely on home improvements and in boosting your wealth. If you start to have a wealth tax on property, as we saw in France at one stage, it deters people from improving their capital stock. But coming back down to it, it's if you're going to make a wealth tax work, it has to be on things that are not mobile. Once you tax things that are mobile too heavily, then they move elsewhere. So property naturally comes to the fore. But it's something that, as you've touched on already, Tom, is taxed, albeit in other ways.
Great, thank you very much. I've had a question here about bond duration and asking us what duration are we currently investing in, which I think is worth saying that it really depends on the portfolio and the risk level. So we tend to have less duration with our low risk portfolios, duration being a source of risk, and slightly more duration with our longer dated portfolios. But I think for clients that have specific questions on this sort of thing, what's really worth doing is registering on our website, and you can actually see the current list of holdings for each different risk level, and it tells you there quite clearly which fixed income, which bond holdings we have. So take a look at that, and if you have any more questions after doing that, I think certainly feel free to send us an email to advice@netwealth.com, and we'd be very happy to go through it with you in detail. I think we have time for maybe one more question. So what else have we got? So we have a question here about are Labour likely to bring in pension protection again, as was previously the case, or to change old protection rules? So I think it's unlikely they change old protection rules. Personally, it is speculation, but based on the fact that they introduced protection themselves at one point, and I think the fact that it would seem very unfair that a specific policy came in to protect people and then it was abolished. And also the fact that it doesn't affect very many people at all. Of course, if it does affect you, it's very important to you. But actually, if you look at the wider population, it won't affect very many people, and it wouldn't raise much money either. So I think it's pretty unlikely, although possible, of course. Great. So I think that's it for now. That's pretty much all the questions covered. So thank you very much indeed for asking them and for joining us today. As I said, if you have anything else or anything more personal, feel free to send those into advice@netwealth.com. Thanks again for joining us, and enjoy the rest of your day.
Great. Thank you. Goodbye.